Hey, what's up everyone? It's Cindy O'Dame. Today, we're diving into the world of finance. Understanding financial statements is crucial for making smart investment decisions. These documents tell you the financial health of a company. Think of it like buying a used car. You wouldn't just hand over your cash without checking under the hood, right? Same goes for investing. You need to know what you're getting into. In this video, I'll break down essential financial ratios in an easy-to-understand way, even for beginners. We'll cover key metrics like the PE ratio, debt-to-equity ratio, and more. So grab a pen and paper, and let's dive in. By the end, you'll have a solid foundation to start analyzing financial statements on your own. First up, the price-to-earnings ratio, or PE ratio. This is a crucial metric for investors. It shows how much investors are willing to pay for every dollar of a company's earnings, reflecting market sentiment. The formula is simple. Divide the stock price by earnings per share. This gives a quick snapshot of valuation. A high PE might mean high future expectations or overvaluation, while a low PE could indicate undervaluation or low expectations. Context is key. Always consider the company's industry and growth prospects. Comparing PE ratios within the same industry can provide better insights. Next, the price-to-book ratio, or PB ratio. It compares a company's market value to its book value. A PB ratio below 1 suggests undervaluation, while above 1 could indicate overvaluation. Consider the company's industry and market conditions before jumping to conclusions. Now let's talk about return on equity, or ROE. ROE tells you how effectively a company uses shareholders' money to generate profits. A higher ROE indicates a more profitable and efficient company. Remember, ROE can be influenced by debt levels, so analyze it with other ratios. Speaking of debt, let's discuss the debt-to-equity ratio, or DE ratio. It measures a company's financial leverage. A higher DE ratio indicates higher financial risk. Compare a company's DE ratio to its industry peers for a better understanding. Now, let's move on to liquidity ratios, starting with the current ratio. It measures a company's ability to pay off short-term liabilities with short-term assets. A current ratio of 1 or higher is generally considered healthy. However, a very high current ratio might mean inefficient use of assets. Similar to the current ratio, the quick ratio measures short-term liquidity but excludes inventory. A quick ratio of 1 or higher is generally preferred. This indicates the company can meet short-term obligations without relying on inventory sales. It's a more conservative measure of liquidity. Now, let's talk about profitability, specifically the net profit margin. It tells you how much profit a company makes for every dollar of revenue. A higher net profit margin indicates stronger profitability. Compare margins to industry peers for a complete picture. Next up is earnings per share, or EPS. It tells you how much profit a company makes for each outstanding share of its stock. Higher EPS generally indicates stronger financial performance. EPS is a key metric for investors and can lead to higher stock prices. Finally, we have return on assets, or ROA. It measures how efficiently a company uses its assets to generate profits. A higher ROA indicates a more efficient company. Compare ROA to industry peers and historical performance for a complete picture. And there you have it. A comprehensive breakdown of essential financial ratios. These powerful tools help you analyze a company's financial health and performance. Remember, no single ratio tells the whole story. Always consider the bigger picture, including industry trends and market conditions. Do your research thoroughly, compare different options, and invest wisely. If you found this video helpful, give it a thumbs up, subscribe, and hit the notification bell for more insightful financial tips. Thanks for watching and stay tuned for more.